Today's session is going to start with a conversation with Naganand Doraswamy, Managing Partner and Founder at Ideaspring Capital. Welcome, Naganand. It's great to have you here. I look forward to getting to know you.
Thanks a lot, Ramana, and I'm very happy to be part of your 567th edition of your weekly roundtable, and it's awesome to see that number and can't believe you have been doing it for that long, and you'll continue to do it for much longer and hit the 1,000 mark soon.
Hopefully, yes. So, Naganand, let's start by having you introduce yourself as well as Ideaspring to our audience, and I'll ask you questions along the way to get more, to double click down on points that we should elaborate on.
Cool. So I grew up in Bangalore and did my undergrad here in computer science, then came to US in '89 to do my master's in Virginia Tech. And post my master's, moved up to Boston and worked for various technology companies. Started with tech in the distributed systems group, then joined FTP Software, where I wrote the first implementation of IP security for Windows 95 and Windows NT. Then I was with Bay Networks, where I was working in the architecture lab, working on the next generation internet architectures. Out of which we also developed a core router for Bay Networks, because in those days Bay didn't have a core router. So we did that and obviously implemented MPLS as well as part of that. And then the startup journey started in 1999. Was a founding member of a startup which was building a 1.6 terabit long haul optical transmission system. 2003.
What was that? Which one was that?
So that company was called Photonex, Photonex. It was started by a couple of scientists from MIT Lincoln Labs and my manager from Nortel, which acquired Bay. So I was there for, it was a lot of fun. We had some 15 PhDs from MIT working on the optics side and a bunch of us on the engineering side. So it was great learning experience, and it was great to work on that product. We got the product to the market, but unfortunately, as you know, 2003, the entire telecom market imploded. So we had to close the company down, and post that I was trying to do one more startup in the fixed mobile convergence space. Of course, the funding was hard, so tried it for a year, couldn't raise money. So then, for whatever reason, multiple different reasons, moved back to India in 2005. We had our own company where we were doing a lot of product development, and I joined my own company at that time. And we, fortunately, there was an inbound inquiry from a Norwegian company called EDB to acquire us. So we sold some part of the company in 2007 and the rest in 2012. So we exited that successfully, financially successfully. And post that is when, was trying to figure out what next, because I had to do a couple of more years post the acquisition. And as you know, the Indian startup market was very attractive. And, since moving back in 2005, was very actively involved. One of the things I realized that did not exist is there was really no investors to invest in early stage product innovation companies, right? If you look at what is happening in India in those days, 2010 to 2016, 15, 16, there are a lot of companies that are getting funding, which are business innovation, aka B2C, but there are not many funds looking at early stage enterprise companies. And my background was all enterprises, and and I was not going to do one more startup after that long a period in being an entrepreneur. Quite hard. And I also have this policy that money without mentoring or mentoring without money, both are useless, because you need to give money, and particularly in early stage also help entrepreneurs in their journey. And having been an entrepreneur for nearly 20 years, I thought that's the best thing I could do, raise some money and not only give the money to entrepreneurs, but really help them in their journey, particularly in the early part of their journey, helping them find the product fit, helping them get the product messaging, and then helping them build for global scale. And so we kind of said we'll do a fund which will not only give money, but also spend a lot of time. So we don't do more than four or five companies a year, but give all we have to be with the entrepreneurs. We are very clear we don't want to take any operational role because we believe entrepreneurs should do that, but be available to them to be able to help them and mentor them in all these various areas that I just mentioned. So that's when we started fund, a small fund. We didn't want to do a large fund, because if you do a large fund, the thesis changed. As we talk more, I'll talk about the thesis. So it's been a great journey. We invested in 16 companies in Fund 1, and currently We are doing fund two. Fund one was $20 million, and fund two looking at doing a $35 million, $35 to $40 million fund two. That's where we are, and it's been a great.
Okay.
It's been having lots of fun.
And all in India, right? Your geography focus is completely India.
Yeah, so the preference is obviously in India. We have done a couple in Fund One. We invested in a couple of Valley-based startups as well, and the reason we did that was we found a couple of partners who were working very closely with entrepreneurs, like same philosophy that we have, but in Valley. But all those guys had the Indian operations. All the product was being developed in India. So we helped on the Indian side, and they helped with the entrepreneur. The reason we don't want to invest in companies outside of India is for the stage we come in. Really, you got to be close to the founders to help them to be available for them. And if you really invest in a company in the US, you really can't add a whole lot of value. And hence, we believe that for the stage we come in, it is always better to be investing in entrepreneurs in India. And that's the only reason that we have a very strong preference to invest in startups based out of India.
So what is the check size that you like to write that allows you to do this kind of early stage investing?
Yeah. So when we started the first fund, Ramana, we kind of said anywhere around 500 to 750K, the first check that we would write, that would help the entrepreneurs to get to a point where they should show some revenue, and then look at a 3 mil raise. And then we would participate with another 500K in the first, following the first round. So our target was about 1.25 mil per company. Obviously, the second fund is double the size of the first fund, so we're looking at 2.5 total per company. And the first check can be anywhere from 750K to 1.75 mil, depending on the stage of the company and what is the requirement, who else are we funding with, and so on and so forth. So we give in our second fund, we are doing bigger because for two reasons. One, we realized that our companies needed a little bit more runway to show the traction that would be necessary to raise the next round. So we're giving them more money. And also, we thought taking a little bit of 1.25 was too small an amount for us to take some in decisions in companies that require more money. So we are doing like now in second fund, we are saying 2.25 to 2.5 mil per company. The first check being 750K to 1.75 mil, depending on the stage, but we kind of cap it at 2.5 per company.
So let's double click down on the first check and the stage at which you like to come in. So you're doing deep tech. Are you signing, concept checks? Are people coming to you to fund concepts, or do you want to see some amount of work done? And what do you want to see before you're willing to write a check?
Yeah, so our preference is to invest in a company which has at least some POC or pilot going, right? The reason we like to do it is otherwise for the amount we give, if they have to start from scratch, then it will really not pan out because they will not be able to develop enough of the product or show enough traction in the market to raise the next round. So our preference hence has been always to look at companies where the founders have spent, like say, 6 to 9 months in developing the product, having some early conversations with potential prospects, right? We don't expect them to have revenue, but at the same time, we don't want to invest in a concept because it takes too long, and for the kind of money we give, we're not sure if they'll be achieved what is required to raise the next round. Because one metric we definitely look at when we invest in companies is when do they have to do the next round, and for the next round to happen, what is the traction they need to see? Because at least today, if you want to do a 3 to 5 mil next round, you need to have some revenues, right? 500 to 750K, preferably hitting closer to a mil. So today is a 5 mil check. So we just want to make sure that we balance that with the amount of money we give them. In Fund One, we only invested in one company in the concept stage, and we wrote a very small check for the founder to kind of translate that into something that is tangible, so that we could do the next round, and that's still going on. But the most preferred one is to come in pre-revenue, but where we can see something, the product working.
And your assumption in the check that you write leading up to the 3 million plus Series A, let's say, what is your assumption? The customers that you're doing deep tech, enterprise-facing deep tech. is the assumption that the customer is going to be in India, or is the customer somewhere else? What are you seeing? What is the assumption based on which you're working?
Actually, if you look at our portfolio, Samara, it's been a combination, right? I think it really depends on the kind of product that our companies are building. So if it's a SaaS, true SaaS, where the annual revenue per customer is anywhere up to 15K, then it is easy to get customers both in India and the US. But if you're crossing 25, 30K per year, then it's hard to convert those customers in the US. So then, we initially get a lot of traction in India. And then potentially before you go to the funding, at least have some conversations going with prospects in the US, because what happens is, obviously, since all the next round of investors know that you would have to expand in the US, and that's a requirement in most of the cases, that in enterprises, it's still a hard market in India, and it is very hard to build a scalable company just in India, particularly if you're just a B2B. If you're B2B2C, then there is enough market in India for you to expand. But if it's just B2B, then growing becomes very hard. You can hit 5 mil, but beyond that, growing to 10, 50.
Yeah, no, in general, our observation is that all deep tech companies out of India, B2B enterprise-facing deep tech companies out of India, are going to be global companies. Even the non-B2B non-enterprise facing, this SMB facing B2B is going to be global most likely. But I guess what we are also seeing though is people can validate with customers in India. So they can get a dozen customers, get the product validated, get some revenue, get to maybe even 1 million ARR before coming out to the Valley or to America in general. So and especially in COVID, because you were asking whether I'm meeting people or not, I think the entrepreneurs love the fact that people are willing to buy without meeting them nowadays. And that has really been a benefit for startups.
Yeah, absolutely right. To your point, the sales mechanisms have changed considerably. But I would say that, anywhere up to 350K, you still can do it. But once you start crossing that, then, the sales process still is very different. But fortunately, for most of our companies, you're not targeting large enterprises. There are a couple of companies in our portfolio where you're targeting large enterprises. And those sales are hard to come by. Even in today's world, not being there in the US, it's hard to convert those when you're selling to, say, Fortune 100 or Fortune 250 companies. That's not an easy sale to be made. But if you're selling to SMEs, then I think it's a golden age to sell remotely, and they don't care where you are, as long as they are able to product. So that's what we have been seeing. So and to your point, I mean, it's India is an awesome playground for people to get their product validated, and also get to 500, 750K revenue, because the good news is, the environment is the same, right? AWS is where you're deploying your product, whether India or US or anywhere else in the world. So the environment in which you're deploying your products are very similar, number one. And number two, when you are selling to Indian customers, which is MNCs, many times MNCs are your customers, they become referrals to other parts of the world, so that they become the gateway to the rest of the world. So I think that's another thing that is working to our advantage. And fortunately for us, out of the top Fortune 100 companies, 85 of them have their offices in India. So I think that's a big plus. But nevertheless, even though you're selling in India, sold to MNCs, but when you start selling in the US, they said, do you have any US customers in the US, right? So the fact that you're sold to the offices in India, it helps a little bit, but it's still a fresh sale when you hit the US market. So that's still a challenge.
Now, talk about some of the companies that you've invested in, and at what stage did they come to you? What did you see that made you want to write the check?
Yeah, like I said, if you look at our fund one, Shravana, out of 16 companies, we invested 12 were pre-revenue, right? And the founders come to us in various stages. So our investment cycle has varied anywhere from 3 months to a year, right? When I say a year, reason being, founders have come to us, they have a business model, they have a product, but we tell them, look, we think it has to be a little different. If you agree with us, we are willing to work with you. No strings attached. And if you once you get that going, if you want to take money from us, take money from us. Otherwise, you can go find new investors, because we do love working with the entrepreneurs, and it's not every day now. We're not saying, oh, if I work with you, you have to take money from me. We don't have that kind of an attitude, because 20% of our time we want to give back to the ecosystem, right? So hence the duration has changed significantly depending on the stage the entrepreneurs come to us with, right? Because in couple of cases they came in early. They said, look, we said we can't invest you at this time, but we will help you in your journey, give you customer connect so you can talk to potential prospects, potential customers. We will give you our thoughts. We will work with you in evolving your idea. So we do that. We kind of stay in their journey, and when they are ready, when we believe they have something tangible, is when we would put the money. So it has been a complete spectrum of time when we have invested in the company. And what do we look for in the entrepreneurs? I guess, one, we definitely, in any company that we invest, if one of the founders is not implementing the product, then we are not investing. Very clear on that, because we are investing in tech, and tech is the moat. And I don't think we can invest in a group of founders where one person is not not building the product, right? So that is what we look for, number one. Number two, obviously,
But in deep tech, that's kind of table stakes, isn't it? Because how else are you going to do a deep tech company if you're not one of the technologists?
Yeah, so when I say deep tech, deep tech is a very relative. I mean, I consider product innovation more than deep tech, right? So deep tech has a different connotation. So the term I use more than deep tech is product innovation. So where you're building something, it doesn't necessarily need to be deep tech too, because in my portfolio, when deep tech to me is a confluence of where you have multiple different disciplines coming in, right? Like, for example, one company in my portfolio, which I consider deep tech, is Simyo, where they're building a simulation to catch EMI, EMC issues early on in the design cycle. A professor from IISc, a confluence of physics, electrical engineering, and mathematics, right? So I think that to me is deep tech. Many companies in my portfolio are great product companies, but I don't know if I can categorize them as deep tech, right? So in those cases, you still could potentially, the founders could have a great product idea, but one of them, none of them might be implementing that. If it's deep tech, yes, but if it's product innovation, it's a borderline. So that's why in our case, we look for that very closely. If one founder is not building the product, then obviously will not invest. That's number one. Number two, we always look for also, do they have the domain knowledge? There is two different ways to look at it. Sometimes they say it is better to not have any domain knowledge because then you can be a disruptor. But we go with the thought process that you need to have domain knowledge, because the reason we say that is you also come in with some customer connects so that you can deploy, get some initial experience of product deployment through your connects. Because as we know, the first few sales always happens because of connects, whether we bring it to the table or the entrepreneurs have because of their previous jobs or journey in their life. So that becomes very important. Third one, like I said before, for the money we give you, for the money you're raising now, where are you going to be in by the time you want to raise the next round of capital? And for that, can you generate enough traction, right? And that's the third thing we look for. And the fourth one, us being a small fund, we want to ensure that we have visibility for 10 to 15 mil in revenue, right? The reason I say that is one of the theses we have in the fund is enable sub 100 mil exits for product innovation companies in India, right? And if you want to get a 70 to 100 mil exit, you should have 10 to 15 million revenue. So that's what our focus is. We don't unlike some large funds, we don't say, okay, can you become $100 million revenue company? Our goal is, can you become a 10 to 15 million dollar company? So with that and with great technology, you're always a potential acquisition target. We're not saying you'll be acquired, but get to that point. And once you get to that point, our belief is then
create options.
Yeah, you have an option. You either go Series B and go all the way for IPO, or if you believe the market is still not huge, you are being part of another larger company is better for you, then find that fit, and then you can make a M&A to that company, right? So that fork becomes really important in the journey of the company, in the journey for the entrepreneurs. And we stay with our companies till that point, and then if they go Series B path, obviously our fund is not something that can participate in that kind of a journey. So then we'll take a call whether we should exit or exit partially and stay with the rest, or that's a call we take. But if we decide that it is better to exit along with the founders, then that's when we help the founders to exit the company. That's our thesis.
Now, in pursuing this thesis, by the way, I'm very much with you in this thesis. I actually believe that the vast majority of exits, I don't believe, I observe, the vast majority of exits are sub 50 million and definitely sub 100 million. And for small funds, I think it's a very good opportunity to do what you're doing. Now, what is your analysis of the maximum amount of capital that you want to raise to support that thesis? So let's say you exit after that Series A point, you're putting in somewhere between 500K to 1.5 million, let's say, and then another $3 million, $4 million round. So are we talking 5 to 7 million maximum capital in? Yeah?
Yes, 5 to 8 million. Within 5 to 8 million, I think you should be able to get to that point. And our thought process is, look, for enterprise companies to hit we are saying 4 to 7 years, it'll take us to get them to 8 to 10 million revenue, depending on various aspects, right? But that's kind of the window that we look at. And then if you're able to do it, and you should be able to do it raising 5 to 8 mil, that's kind of what we believe is a balance.
Wow. So the traditional venture window is $100 million in 5 to 7 years and a lot more capital, obviously. You're saying you want to go from, in 4 to 7 years, you're going to go to $10 to $15 million in revenue.
I find it very hard how somebody can get to 100 mil starting from ground zero, right? If you're starting I'm talking zero revenue, where we come in. Because the typical numbers even people say is 33322, right? That's how we multiply. There might be outliers, but typically, if you take a real case, 3332x is considered extremely good in SaaS, and even in that case, you get to 10 million 5 years. That's the kind of numbers that people usually track. So 100 mil in 5 years, they're outliers. It's not.
But they're outliers, obviously. That's why at the beginning, unicorns were supposed to be outliers.
Yeah.
But nowadays, unicorns have become like an everyday feature, and people are just pumping money and getting a $1 billion valuation and calling them unicorns. My definition of unicorn is you do go at this hyper pace, go to, in 5 to 7 years, you go to 100 million in revenue, and then you get a revenue-based valuation. That is a real unicorn. These other guys are all fake unicorns, in my opinion.
No, I tend to agree with you to a certain extent, because if you're raising 250 mil and 300 mil and then giving away whatever equity in the
company, calling it a unicorn, whatever.
Yeah, I think it's I don't know. It's hard to predict, but there will be some corrections, I would assume, around this going forward. I know you already have started seeing some corrections in the beginning of 2022, and I think you'll see some more corrections happening. But I think probably I'm old-fashioned, so I look at more revenue than anything else, because I think that's how the companies can sustain. Because if you're dependent on raising capital to survive, it's a dangerous game to play, particularly in the enterprise. Yeah. So
what about exits? Have you seen exits already? You've been at this for a while now, so you must have seen exits already.
We have gotten rid of, we exited 3 companies early on for various reasons. So one to IBM, one to Byju's, and one to another company in Chicago, and I manage. But now we are at a point where, like I said, we are starting to hit, 5 of our portfolio are doing more than 2.5, 3 mil. And now we are, like I said, it takes time and patience to get them to 8 to 10 mil. So we are now looking at some exits. There's one other exit that's happening, which we'll announce next month, where we are doing a 10x return in 2 years, which is awesome. So we are seeing that happen, but we are patient capital. We stay with the entrepreneurs for that period that is required, because, building startups from India, trying to sell into the US is not an easy game. We are all getting better at it. And if you look at what the entrepreneurs were doing 5 years ago in India and what they are doing today, there's a phenomenal difference in their ability to sell, in their ability to market, and ability to
Yeah.
build products with great user experience, right? Because those are the three things that we lacked. We were very good technically, we could build a product, but really not with great user experience and not having the ability to sell, right? So I think we have learned all that. There's a solid group of playbooks that are being built that entrepreneurs are sharing amongst themselves. So I think it's progressing really really well, and next decade will be really fun to watch.
Yeah, absolutely. Well, it's a pleasure hearing you and getting to know about your work and Ideaspring. I look forward to keeping in touch, and I look forward to working with you on something soon.
Absolutely, look forward, and thanks for having me on your show, and really enjoy talking to you.
Thank you. Thanks for coming.